Hello and welcome to Property Question Time. This is your show where we put our property experts to task answering your questions. I'm Stephen Galpin, and joining me today are our experts, John Reynolds, founder of Titan Property Developments, and Jamie Pritchard, director of Glenhawk, transitional finance providers. Welcome, guys. Good to have you here. And a new set of questions for you both. Right. Jamie, you're going to go first. I see a number of lenders offering short-term finance, i.e. bridging loans, which could help me purchase an investment at auction and finance on a more long-term basis later when the project requirements become clearer, both in terms of cost and time. What are the sort of valuation expectations the lender will stipulate, and typically what is the normal length of a bridging loan agreement?
So it's good that your client is looking, and the person asking the question is looking at auction finance, and they're looking to do that with bridging, because I think it's the right solution for that because of speed, making sure that you get that through within 28 days and you don't lose your 10% deposit. There's lots of options for that customer when it comes to valuations as well. So I'd really probably want them to have a physical valuation done on that property, because it will determine whether there's any problems with the property for the customer as much as the lender itself. So there would be physical valuation. Now, it depends on the property. That could be just a basic sort of valuation, short form valuation they're called, or it could be a red book valuation, which is a lot more involved, basically.
And you're going to get a red book valuation in and out within 28 days, are you?
Absolutely.
Oh, yeah?
But again, it's using the lender that you know that have got...
John's smiling.
Yeah.
He knows where I'm coming
He's
from
obviously
on that
good,
one.
which is great. It's what you need.
It's good because you don't rely on just one panel. So I've got some excellent panels. So it depends on where you are in the country as well. But I've got 2 core panels that have got valuers all around the country. I've also got a really core panel that we can lean on in, say, the southeast, and actually ask them questions and go to them as well. So yeah, and we actually, through our underwriting teams, manage the flow of them. So if we were sending everything to one valuer, they're going to topple over service-wise, aren't they? So we're making sure that that's managed when it comes to that. The other things that you want to do with this question as well is actually consider, because they said they're buying it, to consider what their options will be. What I would suggest they do when they're buying it is, and before they put their hand up for it, is know what they're wanting to do with said property, and if it fits their business plan. They're looking to buy a refurbishment. Their plan is that they're going to either retain it or refinance. That's the option that they can do. But how much money do they going to have to put down as deposits? How much money have they got to do some of the refurbishments? Do they want to involve that in the bridging finance and lend against a gross development value? So all those latter bits, you may need somebody where you've got drawdown facilities. So as well as the valuation, you may need someone who's an asset manager. That's the person who comes and does the quality checks, as you say, or a quantity surveyor that comes. Yeah. Other things that they'll need to consider, depending on the property, is they may need different types of reports, damp and timber reports. They may need lots of different stuff with regards to structural, but we're getting quite deep on it. But a good broker, again, will help you decipher what is the best lender and what type of valuation cost there will be. Yeah,
Totally agree with that. I typically don't buy from auction, but I buy things that need to be moved on very quickly. So there's a lot of the same principles. And you need a lender that can stand by the timelines that they say. I have had a couple of instances where that has been stressed and strained. Valuation being a crucial one. So where you use that term leaning on, I think where the lender can have a power team around them and make sure that you are part of that in the journey is crucial as a developer or a property speculator that's buying something, particularly at auction, that needs to be moved on quickly.
Well, again, often it can come down to your reputation as well, can't it? If a valuer sees that he's doing a number of projects for you and they've all worked out well, the lender's going to be happy, the valuer's going to be happy, he's not going to be on the line for anything. And
I was going to mention track record, actually, because I imagine that in your capacity you get different people coming in, potentially some with a really good project, but they've never done anything before or done something different. So I think where you've got a track record as a developer, that helps. And if you build a relationship with a lender, then you know each other well, and you can lean on each other.
Well, there's loads of examples that spring to mind with what you just said and exactly what you said there, because as a bridging lender myself, and there is bridging lenders out there that are different, but I won't lend to someone who hasn't got the experience. Now, it doesn't mean that you need the experience in that type of development that John's doing, but I want a background sort of equity. I want some experience in some other projects that we can actually know that when we're getting into bed together, that's, you know what you're doing.
Yeah.
You say for sure that we know what we're doing. And it's the same with valuers, back to your point. If we've got valuers who are, you say, taking longer and not coming back to us, not communicating, they won't be on our panel for long.
Okay, great stuff. John, your question. The government is suggesting that over the next year or so, inflation will significantly fall. Do the panel think that interest rates will track that fall? And will house prices then rise or fall with those movements?
That's an interesting question.
Shall we say it's a trick?
Yeah.
It's a crystal ball question, isn't it?
It's a crystal ball question. I think there's a lot of indicators that suggest that clearly there's a massive lack of supply, and there's still a big demand for property. So whether that's people that are right now procrastinating and waiting out what's been a very volatile time since October with interest rates going up, inflation and so on, but I think we're seeing a stagnation. We're seeing a drop. It was statistically shown to have dropped from October. But to answer the question, I think that people will, to a certain extent, get used to what's happening, understand what's happening, and the motivating factors will mean that people will be in the market. There will be better products available as we go through the year, and prices will continue to potentially then come back up, and the market.
Well, we're seeing
do
some
well.
encouraging things, haven't we? We're seeing cladding on buildings now being acceptable for finance with people like Jamie. We're seeing a lot of vulture funds being formed because the perception is there's going to be a lot of bargains around, and that in itself will drive up activity and therefore drive up prices, won't it?
There's always opportunity, sorry, isn't there? There's always opportunity, jump in on when there's a global volatility going on at the moment. You're right, the base rate's been going up to try and tackle inflation. I'm not sure, as I said before, that lever directly affects the next, because I think there's some geopolitical things going on, let's say, with Ukraine and everything, that are probably affecting inflation as well. However, everything is saying that the inflation should be coming down to around 2.5% by the end of 2024. The base rate will start coming down in 2024, it's believed, but it will go up before that. So these considerations.
But even then, you'll have because of that, you'll have house prices going up.
Well, they will go up.
Which will add to inflation.
Absolutely, it's a balancing act.
It is, isn't it?
Much cleverer than me needs to sort that.
And I just do wonder that you hear on the TV daily, what are the Bank of England doing? The government say, well, it's the Bank of England's job to control inflation. That's what they're supposed to be doing. That's why the interest rates are going up. But as you alluded to, these are matters that are worldwide that are causing this inflation at the moment, the conflict in Ukraine and various other things. So are the Bank of England using a sort of blunt tool really to try and do something that they can't control?
But they've got no other tool. So any of the central banks, so I won't even just
Are they all doing
the
the same all over
Bank
Europe?
of England? Yeah, absolutely. The Fed are doing the same. They're hiking the base rate. They're equivalent of the base rate to actually try and bring down inflation. That is exactly what's happening out there. Now, property prices should probably be falling off a cliff, but they're not. And it depends on who you look. Rightmove saying 2.5% this year. Savills saying up to 10%, and that's moved in the last few programs that we've done. But that's only a 10% decrease. And let's, before we all press the panic button, that 10% has been baked in plus more from what Rishi put in with the stamp duty holidays, which actually caused the opposite effect to what was probably wanted at the time.
Well, I'm not so big on all these percentage losses that we're going to experience, because you know what? If you don't sell it, you don't lose.
Yeah, true. Crystallising is key.
Just sit still for a bit,
yeah.
Because it'll come right sooner or later.
So, you mentioned the vulture funds. There's a lot of people that are expecting opportunity. So use the scenario that people moving during COVID and so on. Coming up April, May this year, a lot of people are coming off a fixed rate 2-year mortgage, and the cost of living, potentially job uncertainty, whether that's happened to those people or not, but they'll be looking at what they can afford, and potentially there are people that have gone into a property that they now don't want to be in. Those properties will come to the market, but there's not necessarily going to be a crash or this potential surge of decreasing house prices, because there are other people that are going to be wanting to buy, again, supply, and the vulture funds or individuals that are choosing that as an asset class they still want to be in.
Okay, well there we are, that's all we've got time for in this half of the show, so join me again after the break when we'll be asking John and Jamie more of your questions. Hello and welcome back to part 2 of Property Question Time. I'm Stephen Galpin and I'm joined by John Reynolds and Jamie Pritchard. Welcome back, guys. Jamie, your second question. Do those that provide finance for property purchase, i.e. bankers and brokers, receive direct pressure from the government or other authorities in terms of encouraging or discouraging lending, and in particular the criteria for doing so? In other words, you're getting government pressure, I suppose.
From different lenders. So I suppose, we're specialist lenders where I work in bridging finance, so it's how you're funded in different ways. So you got maybe the bigger banks have conversations a lot with the housing ministers, and I'm thinking about the big banks that you'll know the names of and building societies out there that advertise everywhere. They'll talk, so I think there'll be a lot more talking back. Examples in the past, Help to Buy. Help to Buy was something that wasn't a pressure from the government, but they brought that in to help first-time buyers and guys, can you flog that, and what do you need to put in for that? And a lot of the conversations around that would have been, how much do you want to put into that deal? We need the customer to put 5%. So a lot of those conversations would have gone into that, not direct pressure. We're actually the regulator rather than the government. So let's go a few steps on this. So George Osborne opens his mouth in 2015 to bring in that there's going to be different tax changes to landlords. What actually happens after that is the regulators, so the FCA, the Financial Services Authority, and the Prudential Regulation Authority. Sorry if I'm boring you with all these parts, but these regulators will bring in some set of rules, parameters that then banks need to, hit and, fit within. And that is what's caused some of the buy-to-let rules that have changed over the years regarding stress tests and regarding other things.
Well, that's what I was just coming to. So actually, the government are indirectly inflicting stress tests on lenders.
So let's answer the question both ways, and I won't get. I'm not one to sort of sit on the fence with these things, but recent past, how many prime ministers did we have last year? But one of the most, not the last one we had last year, but Liz and her sidekick, tried to influence the market itself, didn't they? And the Bank of England and the banks bit back on that. So they can't directly always influence because the rates went shooting up. The rates went shooting up because the base rate went up, because they had no confidence in what the government were proposing. Mm-hmm. And then the banks had to go up with that. With previous programs, we've talked about how they're funded. So the banks weren't trying to profiteer, they were going up because of that. There has been examples before where the government have stepped in and said about customer, tenancy types that are vulnerable types of customers and what they need to do with that. But they don't rule the criteria because it comes back to how the bank is funded, how the specialist lenders like ours are funded, and what the appetite is for us.
I mean, given the 2008 crisis, I can see why the government are concerned about stress tests for lenders and banks, because they want to make sure their balance sheets are strong so we don't have to get in what they call it, a bailout situation again. But there again, the government, I presume it was the government, ordered the de-restriction of stress tests for borrowers.
You're already 2 steps ahead of me, that, Stephen, because it's exactly what I was thinking of. So after 2008, a few things come in. Mortgage Market Review, known as MMR, and also MCD, which is the Mortgage Credit Directive. So within the MMR, that was talking about the stress test and the 3% stress that you put on top of the affordability to make sure that you're not lending people too much that's going to stretch them and they haven't got excess disposable income, i.e. doing things properly.
Yeah. And
most recently last year, they undid all that. Now, it doesn't mean that the lenders, so there's the example, the government, this is a great example for your question, the government undone that and said, you don't have to comply with that stress testing. It doesn't mean that everyone then went, oh, brilliant, let's now go and undo those stress test rules, because the banks and building societies, you've got to be responsible, not only to the people who fund them, but responsible to the borrowers themselves. So not all lenders have now gone, let's undo those affordability stresses, because they're saying it's still the right thing to do, especially in a market where there's living crisis, cost of living's going up, affordability is even tighter. So you'll find since 2008 that there's a lot of good people running these banks. And I know banks is a dirty word to say on you, but there's a lot of good people running the lending arms of these banks who understand new products, niche products, understand actually what the customer needs, and will develop products because of that. Do all the banks get it right? They were the cause of 2018, we know that, and I don't work for a bank, but they were one of the causes of that. They were not the cause of what's going on at the moment out there.
But Jamie, going back to those days, I mean, I think it's fairly widely accepted that it was the Americans who were packaging up these portfolios of rubbish mortgages,
Bonds,
really, and selling them off. Do you not think that if we simply said, if you're a lending institution, a bank or a building society or whatever it is, so you want to lend for 25 years, you've got it for 25 years. Wouldn't that be self-regulatory in itself?
It could be, but I'm always sort of coming back on you with those points. So I get it. You know, I've seen some people say before, can't all the banks have the same criteria? Can't they all say they have to have the same term and own that? That we've become the Henry Ford school of lending then, where there's no innovation. You know, you can have whatever mortgage lender you want as long as it's the colour black. Yeah, like that. You can't have it. If you regulate everything, for example, so I've seen that say non-regulated bridging needs to be regulated, well, you're going to undo the innovation that happens in that market. So non-reg doesn't mean bad, and regulated means good. And you know, the banks need to have that innovation and the changes. Of course, they need to be held accountable, and they absolutely are since 2008. There's lots of rules about liquidity and how much they've got to retain back there, and the rules that they're allowed to have.
You see, I just because I'm old and whatever now, I go back to the days when, if you were buying a house, unless you were a business person and your house was needed for security for borrowing on your business, you would have a mortgage from a building society who were specialist lenders in the residential market. That's all they did. Right now, when they changed to wanting to be banks, and then the banks themselves came into the housing market in a big way, that's when the trouble started for me. Because you're at the mercy of the bank's shareholders and investors and the vagrancy of their marketing policies at any one time. Whereas the building societies, their job was to lend money on houses and finish.
Yeah, but the stress test that came in, you mentioned MMR, I mean, that was sensible. You mentioned as well that a lot of problems were in America, but there was people working in B&Q on 20 grand a year that had 12 buy-to-lets.
Yeah.
And if you actually, and it worked because of how they were ultimately renting them out and getting an income and so on. And ultimately, that chap probably left B&Q and managed to get a portfolio together. But there were people that got it wrong.
Yes. Mortgages as well, yeah.
Yeah, so I think they needed
we
to
all
be stress
liked those,
tested.
didn't we, at the time?
They needed to be a lot more stringent rules coming in.
I don't know how you managed to borrow any money off him.
I've done it once.
They're very responsible, and we do very well. But I think you're back to what you're saying there, and back to the people who are watching this program, is that it is done right. There's a lot more options than ever out there. I know it's been reported that mortgage products decreased after Liz Truss. Well, if the base rate goes up, of course the lender's going to take away their products because they need to reprice them. Yep. There's so much options. This week, in the start of where it was in January, or in the last few weeks, there's actually the most mortgage searches ever in January. So there's still appetite. Doesn't mean that the customer's going to be able to afford it, but there's still that appetite out there. There's a lot of options, and actually a lot of those options out there, whether it be specialist lenders, bridgers, high street banks, building societies, can provide something that's suitable to your needs. So you don't just need to be a business person, but you need to be earning income and all these things. So there's lots of other options, I think, in niche areas that can help out.
He's a tough cookie, isn't he? Well,
he's knowledgeable, though. He knows his stuff. That's
there
what
we
we
are.
need.
John, your question. Now, I can't remember whether we touched on this in a previous programme or on just off camera, but it's this business of panels on a lot of the cladding on the tower blocks. Do the panel think that lenders' reluctance to finance buildings with cladding, recently relaxed, has actually played a part in the downturn in number of transactions and, in fact, the drop in values over the last few months? Has it had a major effect?
It has. In some cases, we've actually had nil valuation on some of our projects, which is terrifying. Just because I think the appetite from the surveyors in particular for some of these properties that have been done under permitted development and then with cladding done, it's just too many negatives from their point of view, even though that surveyor has been instructed by the purchaser and paid, valuation has been paid for with motive to buy. The surveyors have come in and said so there's an effect on either the valuation or the actual processing of that sale through that lender.
Yes.
I think it's, you mentioned it's been relaxed. The government
has taken it off.
Yes, but RICS have not embraced that yet, the Royal Institute of Chartered Surveyors. So where you need an EWS1 form, external wall system, which is all about the cladding, this is still not being embraced by RICS. They're ultimately protecting themselves. And I think a bit like the MMR conversation we just had, they're just trying to make sure that the lenders are being sensible and not caught out by anything that could be front page news with issues on this materials and cladding.
I suppose with permitted development rights, I might be wrong. You would know. You've done these sort of things. But would an office block converted to residential be more likely to have that kind of road cladding on than perhaps a residential building built?
It might be likely to have it on, but typically, and a good developer will change the whole facade anyway. We've done that countless times. They're typically not particularly attractive. They don't look residential. I mean, and I think this is where developers have not helped the situation where they've done it on the cheap. So, you'll have seen that probably more than me. But there's developments that have been done where they focus on just carving up units, getting them either rented out or sold, and of course they have sold. And then there's been issues to follow up. There's been issues internally with kind of supporting posts right in the middle of a living room, and the surveyor did a drive-by. So then you find these things out.
So you just wouldn't see it, yeah.
But back to the cladding side of things, you should really be changing it and, of course, adhering to building regs and so on. Where the challenges have come for us, for example, in one building, which was 3 stories, is you've signed off on building regs, you've done a perfectly acceptable and good job of using the right materials, and then you don't get an EWS1 form, which you need to sell the properties because that conforms to a building type of a 22-storey tower. Totally different use of materials and so on. So that's where the mess is, which is why the government stepped in and said, come on, you don't need it now for buildings under, I think it's 6 stories. But RICS said, we're not embracing it.
So there's a 12-metre rule that's just coming in on the 9th of January, or is coming on the 9th of January. But again, the lenders got to embrace it. RICS have got to embrace it as well. So is it a relaxation of the rules? I think it's just trying to give options for the leaseholders. But again, we need it to be, as a lender, adequate security, that we're able to, especially as bridging, exit onto.
Just interesting enough, Jamie. I mean, I live in a block across the road here, and we've got wooden slats on the balconies, and that apparently failed the SW1. EWS1 certificate. So they all had to be changed.
Every single one.
Every single one. So the developer. I mean, I will tell you that there's 500 and odd flats there, so it's quite a big job, and it took 2 years. And of course, during that 2 years, there wasn't one flat that was saleable because the valuers were saying until the whole building's done, the exercise is worthless.
So in answering the question, it has definitely stopped certain properties transactions that has slowed the market down. And of course, your other option, which eliminates the Jamies of this world, and we've actually done it on one particular building where we've then sold at a reduced number to cash buyers, which is not what you want to be doing as a developer. But you're in this horrible situation where you can't sell traditional route. You've got someone coming in that's sensing an opportunity, and actually the numbers in some cases have worked enough for us to still sell. But it's massively reduced the amount of sales that could have gone through in apartments. That's for sure.
Do you have this cropping up as an issue sort of daily?
Well, I wouldn't say daily, but my sales team do pick that up, and it's a question that we always ask. There's different rules, or there was when we were looking at it last year, between 18-metre height and below, and the EWS1 form, I'm at it now, above 18 metres. Actually, a few years ago, that was the most fraudulently done document as well, they were finding. It was overtaking SA 102s for this, so the self-assessment documents, but there's things that you can spot and do the checks on. So there's a lot, that shows me, if something's been done that way, it's a lot of pressure on whoever's been, is doing it. We do see it. and we won't lend on it, or we wouldn't be able to lend on it because we don't want to be held to the can. Ours is short-term finance. So it's okay saying that the developer is going to change it, or the leaseholder is responsible, and they're going to do that within the government scheme that's available. How long? The example John just gave, or you saying 2 years. You know, how long does that take?
Yeah.
We don't want someone stuck on a finance they're not able to exit.
Well, I think even on this relaxation, they've said that you're going to have to prove either that your freeholder is going to do the work, or you have a sort of consortium that's going to do the work, and that you have the funding to do it. So, I mean, I think it's fairly sensible, isn't it?
Yeah. We've had to wait 10 months just for the right consultant to be able to come out and do the relevant work.
Yeah.
Then there was some remediation work that needed to actually be done. And so the process just takes a long time.
We're back to our own time again, aren't we?
We are indeed.
Yeah.
And that's very relevant, James.
Segue.
That's all we've got time for today. So John Reynolds, founder of Titan Property Developments, Jamie Pritchard, Director of Glenhawk, Transitional Finance Providers. Thank you both very much for coming in. Lively show, very good content. Thank you both very much indeed. I'm Stephen Galpin, and I'll look forward to seeing you next time on Property Question Time.